Hi, good morning. Today we are going to talk about a very interesting topic which talks about the relationship between sustainability and credit risk. First, I would like to talk about the purpose of this activity. We are taking a risk management course where in this class we seek to mitigate the risk default of companies. We are Pacified team and we are students from the Universidad de Monterrey. We found an article written by Andre Hawk and his colleagues where they investigate and analyze whether environmental sustainability has an effect on credit risk of non financial European companies to help investors make better investment decisions. This article is quite interesting because there is a growing trend to make better investment decisions focused on sustainability. Investors are looking for companies that implement sustainable activities within their operations, and this article investigates whether there is a relationship between more sustainable companies having a lower probability of default. The reason why the research was carried out was because Europe wants to support the shift towards a more sustainable economy by implementing the Sustainable Development Goals. So, with this transition to greener economies, the objective of this article is to investigate if there is a relationship between sustainability winning a company and the credit risk. Also, if sustainability parameters could be useful to calculate the probability of default of a company. This article found that a company compliance risk could be negatively affected by a lack of environmental sustainability. First, companies with a higher environmental sustainability have a lower regulatory risk because they have a lower probability of being fined for environmental misconduct. And they also are better prepared to adopt any environmental regulatory changes. Also, companies with a lower environmental sustainability face higher stakeholder and reputational risks. Also, companies that are less sustainable, particular with the respect of environmental factors, have higher even risks. For example, the Exxon case, the TEPCO case, etc. All these factors help to develop the first hypothesis, which is that companies with a higher environmental sustainability have lower credit risk premiums. There are several studies that support the hypothesis. For example, the Graham study that talks about the companies that do not show environmental obligations, and these have a higher negative impact on bond ratings. And this case is very similar to the Snyder story. Bauer and Han did another study where they confirmed the positive impact of good environmental management and their bond ratings and yields. Another study concluded that considering environmental and social criteria improves the prediction in credit ratings.
Hi, my name is VIDEO.H2.PASIPHAE.ARF2 and I'm going to explain the data and the results of this case. Well, mainly, the starting point for this sample is the MSCI Europe Index, which includes more than 400 European firms. But for this study, financial firms are excluded from the sample for two reasons. The first reason is the companies from the financial sector have no essential impact on the environmental and thus exhibit low indirect environmental risk. They mainly face indirect environmental risk due to their loan portfolios, which have to be assessed. And the second reason is credit risk models differ for financial and non-financial firms. For that reasons, most studies regarding credit risk focus on companies from industrial sectors. And well, in this study, CDS spreads are used instead of bond spreads to measure default risk premium. There are three advantages of using CDS spreads. The first advantage is CDS prices reflect changes in firm-specific fundamental data faster and accurately than bond prices, in which tend to follow the CDS market. The second advantage is the CDS is a pure measurement of credit risk. The CDS premium doesn't have to be separated into a term structure, credit risk, and financial risk premium. Well, the third advantage is when the CDS is used instead of bonds. It is not necessary to account for different and varying maturities due to their fixed tenor. And well, based on prior studies, both fundamental and stock market data used with the sustainability factor to explain the default risk premium of companies. And that brings me to the results. Then I'm gonna provide a detailed overview of results for the hypothesis. In first place, the impact of control variables on the CDS spread is discussed of every sample. After that, the general impact of environmental sustainability and the moderating effect to creditworthiness is analyzed. However, there are two exceptions. All the control variables based on the stock market have to accept impact on CDS spread through only the effect of stock volatility is significant. And well, the results are logical in the view of a structural framework because a bond has limited upside and unlimited downside potential. So both investors focus on more on the possible losses for which the stock volatility is better estimated. Moreover, volatility is especially important for the firms with high leverage. This is possible with regard to Merton structural framework as well because high leverage is associated with a low distance to default, which reinforces the effect on the stock volatility. And well, the fundamental variables have the expected effect on the CDS spread as well. Both profitability and market capitalization have negative effect on CDS premium. That means that companies that are profitable and have higher market capitalization and have lower credit risk. These findings, based on whole samples, show that environmental factor has negative impact on CDS spread. Therefore, the firms with a higher environmental sustainability have in general lower CDS spreads. This support our first hypothesis, which stated with regard to risk mitigation view that more sustainable firms have to lower default profitability and have pay less for their debt to lower regulatory recapitalization, financial, and even risk. So environmental sustainability has a big influence on credit risk premium of companies that have high credit ratings on good creditworthiness. Moreover, the effect is strong for companies with a low leverage and high market capitalization, whereas it doesn't pay off to be a green for small and in-depth companies. A reason for this result could be that leverage and market capitalization are more important indicators for firms' abilities to fund sustainable development. So, a firm has a high leverage or a low market capitalization. The investors prefer pay debt of retaining the earnings to investing in environmental sustainability in respect of the profitability. And finally, in our conclusion, in this case study, we analyze whether environmental sustainability as an effect of credit risk of a European non-financial companies to help investors make good, sound decisions when incorporating sustainability into their investment process. And the findings show that more sustainable companies have lower credit risk due to lower reputation, financial, and regulatory and event risk, which provides a proof for Fizz hypothesis for the risk mitigation view. Furthermore, our findings indicate that a company a company's credit worthiness moderates the, the impact of environmental sustainability on credit risk. So finally, invest professionals should integrate environmental criteria into assets of a company default risk and consider the moderating effect of firm creditworthiness. Well, and this integration should improve exciting credit models and lead to slightly more precision valuation credit risk. And well, that's it. And thank you for your attention and your time. See you soon.